What is a property plan? Who uses them? Who creates them? What goes into them? Do you really need one if you want to build an investment portfolio? And where can they go wrong? Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent, co-host of Foxtel's Location Australia, and author of Auction Ready.
And I'm Chris Bates, mortgage broker. Before we get started, I need to let you know that nothing we say on here can be taken as personal advice. We always recommend you engage the services of a professional.
Don't forget that you can access the transcript for this episode on the website, as well as download our free Fool or Forecaster report, Which Experts Can You Trust to Get It Right? theelephantintheroom.com.au. Back in February, I interviewed the chair of the Property Investment Professionals Association of Australia, Peter Kalizos. And I was shocked to discover that you don't actually need any qualifications to become a property advisor. So it's possible that you could have someone who left school in year 10 and studied nothing since put together a property plan for you. Now, that's probably a bit extreme, but it has got me wondering about whether property plans hold any value for property investors. Now, Chris is the perfect person to discuss this with, as he has, in fact, worked as a property planner in a previous iteration of his career. So let's start with why somebody might seek to get one done. What do you reckon, Chris? Why do people think they need a property plan?
I think what Peter's saying is very true, and it's a big bugbear of mine and yours and everyone who's trying to do the right thing in the property industry, because we all want it regulated, right? We get frustrated with how people are getting sold, dud investments, whether it's off the plan. We all know about many groups out there that pitch themselves as property experts and sell new developments off the back of research, etc. And we all want the property market to have higher standards. Unfortunately, the government's got no interest in regulating the property market because it's such a cash cow for them on so many levels, and they just want to let it run free. And so the danger with this is, organisations like PIPA, REBA, are trying to, I guess, improve standards, but they're fighting a big property industry that's built off new developments, and the government's very much aligned with them rather than giving good property advice. So that's sort of the lay of the land. But then you've got these things called property plans that I've seen many different versions of them, obviously. You've got people who, a lot of the big spruikers use them. They say, come on in and we'll put you an investment property plan together and we'll forecast you out how this is going to make you a lot of money. And they spit out a spreadsheet that's got ridiculous variables in there and forecasts around capital growth. It's got 7% capital growth rates. It's got your rent's going to keep on rising forever. It's got huge depreciation in it. And they'll say, look, if you buy 1, 2, or 3 of these, this is how much it's going to cost you per week, $5. Why don't you buy 3 of them, And so they're used a lot by spruikers, definitely. I think then you've got just a bit of a warning around financial advisors aren't trained on property. Financial advisors generally, the level of education's, standards are having to improve. There's new degree thresholds coming in the years to come, and that's why advisor numbers have almost halved.
Do you know, I was speaking to a financial advisor today, a young one, and he said that a lot of the old financial planners who didn't want to actually up their educational qualifications to meet the new standards have become buyer's agents. Have you heard of that? I haven't heard of that.
I've seen a few brokers as well, that have become buyer's agents as well. I would not want to become a buyer's. I think it's a tough job, to be honest, Veronica. I think the hours are pretty crazy, the time frames you have to work, and your product is hard to find. When you want to buy quality assets, you could be a buyer's agent to buy poor assets, and that might be easy, but to buy good assets, it's tough, right? So anyway, that's to good buyers agents out there, you guys work hard, and I don't think it's an easy job to sort of master. But the financial advisors aren't trained on property. Now, this is for 2 reasons. One, it's unregulated market, and it's hard for them to make recommendations in it with compliance and PI and all that sort of stuff. But 2, it didn't align with their revenue model, because when they recommended clients buy property, it meant they had less funds they could manage and put into investment funds, put into super, all these sort of things. And so they didn't want to recommend clients to, buy property, because it meant they had less money to manage, which means they would make less money. And so the whole financial advice industry has completely ignored property, and they're the biggest bears of property out there. They don't want to admit that we look at all investments, but no, unfortunately, you don't look at property, and that's the biggest asset in Australia and people's biggest asset. So, unfortunately, so you got some financial advisors, very few that even look at property. I joined one of those companies, and it's the reason I joined them back in 2012 was because like, this is different. It's actually a financial advice business that actually incorporates property. I don't know anything about property. Let's sort of figure this out. And fortunately, they had good property ethics. I didn't know what good property ethics were back then, but fortunately they did, and they didn't go anywhere near the new stuff, and they worked with buyers agents, and it was just lucky. But there are financial planning groups that are getting hit up every day to work around property, because property's become a massive revenue stream for some financial advice businesses. Because what they'll do is they'll get a real estate license, and they'll do this property plan, and all they're really doing is pushing people into new property, which gives them big kickbacks, and they've been able to slide around the legislation there. And so you've got to be really worried about them. So you've got the spruikers. I'd be really worried, obviously, preaching to the converted. The financial planners who do property financial advice that then push you to developers. We've seen, we've had to unwind clients from them. And then you've got these sort of new sort of businesses that maybe started as buyers agents or started as mortgage brokers, and then they're doing these property plans, and now they've started doing financial advice down the line. These are pretty interesting ones as well, and there's not many companies that work in this space that do these sort of semi-financial advice property plans. But that's a long-winded answer to your question. But I think who needs it? Who would want to get it? Most people who want to make decisions around property, they want to get good advice. The problem is there's a massive shortfall on where to go. You can go to mortgage brokers who most of the time are just going to peddle debt. Even this morning, I told a lady, what are you doing buying property? You're 59. It doesn't make sense at this point in your life. Well, I went to this other broker and, I was working for this franchise company, and they told me to push me to this developer who was going to sell this. And I was like, yeah, you stopped yourself, which is great, and you've come, but, you need to be getting good financial advice and looking at your super. So, but if you go to most brokers, they're going to peddle debt. If you go to most buyers agents, no matter which one you go to, most of them, unfortunately, have got a scarcity mindset. And when you get in there,
they'll peddle property.
Yeah, you go in there and I've got a budget of X because I went to a broker and they said I got this. They're going to push you. And unfortunately, I'm not a fan of investment buyers agents, who just solely do investments and buy all over the country, and borderless sort of buyers agents. I mean, how can you possibly be an expert across the whole country? And we could talk about those. So anyway, I think that's sort of, most people would want a property plan. Unfortunately, you just got to be careful who you get it from and what are they trying to peddle. And that's what I think we can talk about today.
Yeah, and I do want to get into sort of deconstruct a property plan, because from my observation, and we see quite a few people come to us after having paid for a property plan from someone else.
Yep.
And they may instinctively know that it's a sales pitch, and so they're thinking, oh, hang on a minute, it doesn't sit well, so I've got my plan though, so let's take it to a buyer's agent and start the process. Some of those plans, I think to myself, wow, I really don't think this person should be buying property at all.
Yep.
Because if you go to a property person, unlike me, I'm the weirdest one of the lot that often says don't buy property. Very unusual. If you go to most property people, they'll say, right, we'll give you a property plan, and property is going to be all that you invest in. And unfortunately, a lot of people are biased towards property without knowing any better and without understanding where that can be good and where it can be bad and where it fits in your whole life, stage and all that sort of stuff. A lot of people are looking to replace their income with property, so they buy the wrong properties.
Yeah.
And they're chasing, even today I was talking to somebody who was talking to potential client about somebody who wanted to buy a house and land, package, build it, get it valued at $150,000 more than they paid, so that they can then borrow against it and do it again. And it's like, this is going back 10 years. This is all the stuff that was, back in this great loose lending environment was going on. And it's like, you can't do it for lots of reasons. And also, where does this magical $150,000 worth of equity just suddenly drop out of the sky? I mean, seriously, if it's that easy, why isn't everyone doing it? It just, anyway. So you got these property plans that are put together. Either they're trying to sell something, or they're put together by people who buy, like the borderless investors, who basically want to sell you up a package of buying everywhere across Australia and carve up your money and carve up your budget. And property's the only way to go.
Yeah.
And it's like whenever they come to us with one of those sort of plans, it's like, okay, can we just, I know you've just gone through this whole exercise to get the plan in the first place, and you probably paid a couple of grand to get it. But can we just sort of go back to step one and understand your goals?
Yeah, for sure.
Because I'm not certain that this plan that's been put forward is actually going to help you achieve it, because I'm not certain property is the vehicle, and I'm not qualified to advise you what else is the vehicle. I just know that property doesn't actually deliver in the way people think it does. And B, what's allocated for Sydney isn't necessarily going to get you what they've told you it's going to get you. And then they've punched in, and you see this annual growth figure of 7%. And it's like, well, yes, it's possible if you buy the right asset and the market does what you want it to do.
That's right.
But it's not a given. And so therefore, what happens if it doesn't do that? And then if you are actually, your allocation is all wrong for different markets, then you're going to be buying a B grade asset instead of an A grade. I mean, it's just none of that's been taken into consideration in the plans that I've seen.
Yeah.
And so I thought, and the other thing that I see a lot, particularly with these property plans put together by property experts, rabbit ears around the word experts or advisors, is that you get this idea, and you tell me if you've sort of seen this, and maybe you can elaborate on this in terms of the numbers end of it. They say, right, you got to buy the first one, it's A grade, although we don't want you to spend everything because we want to keep some money aside, so that as soon as you've got, some equity in that, then what you do, you'll actually buy a lesser property but with high yield, so you've got cash flow, so that then you can buy another one after that, and you can start building up your property empire. Now, I have a theory that this is probably one of the reasons why was it 73% of property investors stop at one. Because of that sort of advice.
Yeah, I mean, there's so many problems with forecasting. I mean, as a financial advisor for a long time, the advice is built off a modelling, and you have to create a model to justify your advice, why that advice is better than doing, this alternative strategy. And you used to plug it into every system offers it for financial advisors, like Xplan's a big one, they use. And in Australia, it's probably one of the biggest ones. And so you plug it in and it put all these variables in, and it would forecast how your income's going to go up. And look, the reality is the world doesn't work like that, right? Like the property market went up 30%, let's call it, last year. Like it didn't go up 4%, and it's not going to go up 4% next year. It went up 7 years of growth in 1 year. Now, your plan's going to shift and vice versa. If the property market goes flat, or, or you decide to, quit your job and all these sort of things, you can't plug into a model. Life's unpredictable. And my big frustration is it was always selling the dream. Like, you want to retire at X date and you want this amount of income, right? So if you do nothing, you're going to be at this point and you've got this big gap. So what we need to do is come up with advice strategies to help you bridge that gap, right? And then when you get to retirement, you're going to be fine. And this is sort of the problem. It's sort of this fallacy that we know that investment returns are going to be X over this time, and but we don't know. Life plan change. Your income could be a lot more, right? You pushing for a promotion, you get it earlier, or you don't get it, or you have no kids and you thought you're going to have kids, and all this sort of stuff. So I found the whole forecasting thing a little bit of a sales tool to sell products. And most people can't know what their plan's going to be. People's lives change, right? You didn't think you'd want to do what you're doing today. Maybe your hobbies you do today, you wouldn't imagine doing them 10 years ago. I love my gardening now. I didn't love it 10 years ago. But, it's going to change. And what you want to spend money on is going to change as well. Like, you might want to travel lots, but when you get older, you don't want to travel at all. You just want to, get a caravan. So things change. That's my whole frustration with forecasting, and generally there to sort of, sell the dream, sell the shortfall. And the problem with property plans, you've got financial advisors who do that, which should incorporate good financial advice in there. They should be looking at your super and salary sacrificing into, your super and making sure you hit your maximums. They should be making sure your super fund's all in one fund and making sure it's a low cost fund for you. Making sure your insurances are fine and you've got the will set up and your testamentary trusts and, all these sort of things they should be doing. Then, someone, if you go to get a property plan, they're saying, well, don't worry about super, don't worry about shares, or don't worry about, doing debt recycling and, dollar cost averaging into an ETF. Let's just buy property. And it's complete. I don't think you should be in either camp. I think it's being very ignorant to say property is the best asset the only way. Because as you get older, residential property becomes very lumpy, very low yielding. You can't just sell the bricks of the house when you're in retirement. So you don't really want a lot of residential property when you're in retirement. You want a lot of liquid, high yielding and high growth assets like, shares, commercial property, ETFs and things like that, REITs. So that's another big frustration with it is that, and unfortunately you go to financial advisors for that property plan and they don't really know what they're doing around property. I would say it's, they haven't gone down this journey, which takes many years of trying to educate yourself and build the relationships.
They don't. It's funny. I was chatting to this young guy today and I think his heart's in the right spot, which is a start. He's not trying to capitalise off people's desperate desire to accumulate properties. And he was basically, talking about some of the things that he's had to unravel with his clients that come to him after they've been sold these dreams. And it is hard because, of course, property is a lumpy asset, which basically in financial planning terms means that it's impossible to create a balanced portfolio with someone unless they've got heaps of equity. And if they want to put one property in the investment mix, and also if they're living in their own home, they're buying their own home, think about it. It's how can you possibly just try to say it's balanced? And so you can certainly understand why financial planners, if they've been the way in which they've been educated, and they've got a lot more education and understanding of other investment vehicles than the average Australian does. And so they probably would look at property with, in alarm, thinking, why would you take that much risk on one asset? Yeah. Why would you borrow that much money just for one asset? And this is where the quality and the focus on capital growth has to come in, because that's exactly right. Why would you? Unless you were very confident it's a really, really good asset. And as you're saying, also moving through your life, like I look at resi property now, it's unlikely that I would buy another residential. At my age, I'm in my early 50s. I hate to admit that, but the other half of me is very proud that I'm there because that's better than being dead, right? But I would be loath to invest in residential real estate now. Because of that short runway potentially, if I was going to retire in 10 years, which I'm not anyway, but like if I had only 10 years left to working, there's an element of risk with that. I think there's enough time if you buy a good asset, but at the same time, and if you don't have enough equity behind you, then you do have to look at that. But this is where the conversation comes into where are you in your life and where are you in terms of your assets now? Yeah. And the risk conversation. Stuart Weens had this great two-part podcast on commercial property. Did you listen to that by any chance?
No, I haven't listened to it, but it sounds like I should. But what you say there around sort of, your age, I guess, in terms of it is a tricky point. And, this is where you say, well, look, it's maybe, if let's say, early 50s, it's usually fine because you've probably got at least 10, sort of 15 years potentially till you stop working, everyone's got different lives. But when you get to the mid to late 50s, getting close to 60, that runway can start to get really short, especially if redundancies come in. We all know how sort of ageism and, all these sort of things that happen, right? So I just think it's a tough part to really talk about investing. And when people come to me at that age, we don't really do any marketing to encourage that, but sometimes clients did, like one this morning. I think at that age, I really encourage them to make sure, are you even maximizing your super? Oh, no, I haven't even done that. Well, that's the biggest option for you ever. You get a huge tax saving. So you need to be doing those things before you even look at, other options to grow your wealth. So
it's the holistic advice that's so important. And this is the problem, and it is a very real problem. We can't actually provide a solution for it in this episode because it's something that this year I really want to look at ways in which potentially we can help solve this for people, is that people want to invest in property, but, if you're a nail, everyone's a hammer. Everyone in the property game's got a hammer, basically, and they look at everyone like a nail. So property is a solution, right? And that's an issue because property is not the solution, or the type of property or the amount of properties or whatever has to be looked at, and there has to be respect for the differences. But if you go to most financial planners, because I put a post on LinkedIn saying, just a shout out for anybody who's a financial planner who understands property, except you, Stuart. I know that you understand property. Who else, right? Yeah. I had one person Now, maybe I don't have enough reach, perhaps, but I had one person reach out. Now, this happens to be a financial planner who is a mortgage broker. So I don't think he understands property anyway, but at least he does understand that people are making really poor decisions. He gets that, right? And he also, he's observed and had to unravel some pretty horrible situations. So he has an understanding from that perspective, which is great. But there's one person. Yeah. Maybe I really am a bit lonely on LinkedIn, I just don't have enough people. But I thought that was really interesting. They're not even trying to sell their services to me.
Well, most financial planners clients are, the pre-retirees and retirees. Most people go and get advice, even if it's for lots of things in their life when they've got a problem. Like if you've got something with your back, you only go when you're in a lot of pain. And a lot of people only go see financial advisors when they go, SHIT, retirement is only 5 years away. I need a solution. Then they go to an advisor and say, what's the magic, ticket? How can you solve all my problems with some advice? Well, you probably should have done this 15, 20 years ago.
Can we wind back the clock?
Yeah. And, there's nothing I can do. I can't give you 15% investment returns. And you're not telling me you're willing to save $1,000 a month. And most financial advisors work in the pre-retiree space, damage limitations, probably the word of it, and try to bridge that gap, which usually is quite big. Or they would deal in the retiree space. So people have, probably done things for themselves, and now they just want to sit back and go get a nice coffee in a nice office and get told about their investment portfolio. And a lot of advisors just clip the ticket there as well. That's being a little bit easy, hard on advisors, but that's, how it sort of works. Not many advisors work with younger clients, and it's a real gap. The reason is because it's for them to make profitable advice. They're going to have to charge you to run a profitable business. They've got families to feed and they want to get ahead of themselves in life. And for them to run, they're going to have to charge you some money. Even if they did 100 plans a year, that would be a lot of work. And so, to have to charge, $3,000-$4,000, at least, I think, to sort of generate that advice, if you think about the hours they put in.
Yeah.
And not many young people want to pay that. The reality is it's a big thing. And they don't really want to do one-off advice, like trying to find 100 people and do that one-off advice. So they want long-term relationships. And a lot of young people aren't willing to pay a lot of money for advice. And so young people are sort of lost. They're sort of out there, not sure where they can get advice, hence why the Barefoot Investor did so well. Other podcasts out there have huge because they provide education and there's a big shortfall. But around the property for young people, it's just a big sort of gap. And this is where people go, I'll go to a financial advisor. But they don't really deal with young people, and you pay this fee. And they don't really understand property. And that's your biggest opportunity when you're young is property. And so you're sort of gone to the wrong person who doesn't really have a product. They don't really understand the biggest opportunity for you is property. And then
you go to a property person who may not understand property themselves. Yeah. And, that's just equally alarming. It's probably more alarming, actually, because then there's a wasted opportunity.
Yeah, I've seen a lot of people coming out of professional jobs that have gone and bought a few properties for themselves. And there have been a lot of tailwinds behind the property market, especially in the lower quality assets. They're not comparing to what they could have done if they bought absolute top quality, but, and then all of a sudden, then they hate their corporate career and they've just gone and become a buyer's agent. Now these investment specialist buyer's agents, and they buy everything. And, I think that's really dangerous people to sort of go to in terms of getting your advice, because they're still early. They haven't got the runs on the board. They haven't had these learnings. They maybe bought 4 or 5 properties for themselves, but they haven't had hundreds of client transactions.
Well, also time, because the reality is that you need a good decade, and then you need to actually reflect back and benchmark in order to be able to measure the performance of the properties that you do have, in order to work out whether you've actually done well or not. I mean, so we've got a lot of history there in terms of our clients. We've got, a couple of different boom bust cycles. We've got, good longevities, have some resales. And so there's good evidence, behind that. But I'm the first person to put up my hand and say, but I have learned a lot myself in that time. And I know our advice now is better than it was 13 years ago. It was as good as I could give 13 years ago, but I know it wasn't as good as it is today, know. And that is through my own education, this podcast, but also just through reviewing and reflecting and benchmarking and revising and looking at what we've actually done and how they've performed and what's done well, what hasn't, and why, and understanding that. If you like what you're hearing here, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars, please. Every review helps make it easier for other people to find us and hear what our amazing guests have to say. We love hearing your questions and we're planning more listener Q&A episodes. Please send your questions in. You can send them via the website, which is theelephantintheroom.com.au, or directly via email to questions@theelephantintheroom.com.au. So I think one of the big issues
It is actually that, Veronica. It is like looking and comparing and literally playing on RP data. What did they pay for it? What's it? Where is it? Why hasn't it performed very well? Why is, they bought that property here, hasn't done anything for that long. Like when you do that for thousands of people, and that's not an exaggeration for both of us over those time, you have a lot of learnings because you can see all the things that have really worked for people. Why did that go so well? Like, what was the ingredients that, they got such a good result, and why did that go up so much and that didn't? And, and that's just something you get with experience. And you sort of be, if it's your calling, I guess, if it's something you wake up and you think about, it's not just for your clients, it's reading and researching and things like this podcast for us that, add on top of all these client experience that we're sort of throwing on top.
The funny thing is, though, there's a lot of opinions out there as to what makes good property. A lot of it's dominated by the quantity argument, right? That somebody's...
I've never seen it work. So
no,
that's the
I
thing.
haven't either.
And I've seen, we've got a number of clients who have gone to these people, and the quantity strategy has never worked for a single client. And I can say that. We've had to unwind clients from 8, 9, 10 plus properties.
Yeah.
And, what's worked is usually 1 or 2 of those properties that they purchased prior to they went to a spruiker and they had a house in the Gold Coast, in a good area of the Gold Coast. They bought it in the 90s sometime and that's gone from 400 to not $1 million, let's call it, right? Maybe gone up a lot in the last 2 years. But, and it only worked because it's a house on a good street and they didn't really know what they were doing. They just bought in a suburb where they grew up or something. And maybe they bought one property that was, a semi-good, house in a good area or something, and that's gone. But most of the properties have been laggards or done nothing. And, I've just never seen it work. That's the thing. And if anyone thinks they've got the quantity strategy and it's really worked for them, come on the podcast. Let's talk it and let's prove us wrong. If anyone's bought an off the plan, that they think really is an amazing off the plan, send it to us. I'm happy to talk about it. Put it through as a question. And, besides the high end sort of off the plan market, which is sort of the penthouses and, that stuff, that's premium off the plan can definitely work because it's scarce product. But cookie cutter off the plan, come to us, show me. And that's the thing we do. Yeah.
There are exceptions to the rule, let's face it. There's exceptions to the rule on both sides of this. And every now and then you come across somebody who has actually managed to luck it, but they don't realise it's luck. They actually think that they've got the Midas touch. But this quantity sort of idea as to that's how you measure whether somebody's a good property investor or not, that's a problem with that metric. And it's a metric that's perpetuated by people who have something to gain out of that, and that is spruikers and developers, right? There's also this idea about, the renovation dream, and that's the scary one too, because not every property deserves to be renovated. And I hear this sort of, there's some of the plans that are around buying in really low socioeconomic areas, doing cheap and cheaper renovations, getting big rent for it, and then supposedly getting it revalued because of the cheap and cheerful kitchen and the paint job that you've done, that suddenly you get, you make all this extra equity. And then it goes back to quantity though. It's just not the brand new quantity. It's the really cheap type property. We interviewed on the Your First Home Buyer Guide podcast, we interviewed Matt Ward. He's the buyer's agent out at Orange. And he was talking about people who go out far west and they could buy a house of, $50,000, put a tenant in it, get really good rent, and like 6% on 50 grand is not a huge amount of rent. And then if the air conditioner goes, because they all need air conditioners, that's basically a year's rent,
Well, that's the thing with renos, right? Like if you want to renovate a $300,000 house, like to do the electrician for a day, if it's $1,500, that's a lot of money, right? If you spend $1,500 on a $2 million house, it's the same thing. Set 10 hours at the house plus some materials, right?
Yeah, exactly.
And so renovating, you're going down to the poorer quality properties in terms of scarcity and demand and all that sort of stuff. And then you're trying to reno them. Reno is tough anyway. It's expensive. Labor's not cheap. That is a risky strategy. We just had a client yesterday who wants to buy a B or a C grade property in a B or a C location, let's call it. So, not the best property in the best suburb, I would say, and then do a big reno on it and then flip it and then make lots of money because they, got industry expertise, and then flip it and get into an A grade property in an A grade suburb. And
it sounds wonderful in theory, doesn't it?
Yeah, and it seems like you're going to make so much money, because you can do this in a depressed market, I would say. When you can buy a B, C, or maybe not a D, but a property that's it's a good location, but not a great street, maybe not the perfect house, but you can dolly it up, I guess. And you buy it really well, you do really cost efficient reno, and then the market moves upwards, and then you sell it at the top of the market, and you can make really good money in there. But it's all about the timing, right? Which is out of your control. Like, buying it at the right time for a really good price, doing the reno, nothing going wrong with the reno, no, big things, skeletons pop out, and you're like, oh, I didn't know about that. And so you can make doing these reno strategies, but it's hard. It's not like the block, right? And usually it's the market that makes you the money. If you just bought the house and didn't renovate it, you probably would have made just as much money than doing the reno.
A lot of it is timing. In fact, I got Kent to give me some data, which I'm playing around with at the moment. And basically it was a whole bunch of properties that sold and then have sold again after 10 years. These are all just in New South Wales. So I'm basically doing some case studies to show the difference in growth, different properties. Some have been renovated, some have performed really well, some performed really terribly. And it's all different scenarios. If you pump them into some of these these property plan sort of templates that I know exist, you can imagine, there's all, if assuming somebody bought 3 cheap and cheerfuls, 10 years ago, where would they be today versus one cracker versus a real, a B grade in a supposedly up and coming or whatever. So the comparisons, and I haven't finished this research, and so once I've finished it, maybe we'll do an episode on it, but it's just fascinating, the differences and the different scenarios after 10 years. And this is what it all comes.
The renovation cost in there as well, or the shortfall, like the negative gearing cost or the maintenance costs. Some of these things are hard to factor in because you don't know those unless you know it's been renovated and had no idea what that's going to cost. And
I start with those because you can generally find the links online, right?
Yeah.
So I start with those that's quite obvious they were sold both times in the same condition.
Yeah, perfect. Yeah, exactly. Take that.
And so that's the starting point. And then the next iteration of it is that I look at ones that have been renovated and I'll use an estimate on what that may have cost. And that's, I did this research years ago. I've spoken about it on the podcast before in Roselle, but I didn't have Kent's nice little spreadsheets to help me. It was a lot more laborious. This one is, and this one's across New South Wales, not just in one suburb. So, but it really does illustrate that what you buy is what makes a difference. So this is the same time period. I could do similar. I could try to pick chunks of the market, rises and falls, and all the rest of it, and start extrapolating it over different. Does timing really work? That's a little bit more complicated. But this is to say, in the same time, same conditions, different outcomes. What was the input at the beginning? And so back to the whole property plan thing, I think that if people who are putting the plan together or implementing the plan, or both, if they don't understand what actually makes a good asset, they don't actually understand that plugging 7% annual growth is sort of misleading in many cases, then, of course it all looks rosy. And because, of course, a rising tide does not lift all ships, despite the fact you'll hear property people say that all the time. It's bullshit.
Yeah. The hard part is if property's growing that fast, rents can't grow at 7%, wages aren't going up that fast, right? So your yield's just going to keep on getting smaller and smaller, right? And in 10 years' time, do the numbers of what that yield would be. You would say, no one's ever going to be able to pay that much rent if you multiply rent by 7% every year. And things like
Oh, they
that
don't.
pop up.
I don't think that. I have never seen anyone pop in a 7% per annum increase in rents.
Yeah.
Have you? Have you seen that?
No, but if you did do that, you would see how rents. So what happens is your yield gets cheaper and cheaper, right? And
Of course, because
and so,
yes,
yeah, and so it
yeah.
starts to look, well, the yield's 1%. Like, that doesn't really make sense. And so,
Which
it's
is, well, that's exactly what the problem is with investing in Sydney at the moment. To get a decent property, you're happy if you get a 2% yield. And that is because prices are, as you say, they rise so fast that rents cannot possibly keep up. And rents don't have the same elasticity as property prices anyway, because there's just not the exponential drivers to the rental market. But also people sign leases. And so their rents aren't going to go up until... If they do go up, they're not going to go up for like 6 months or 12 months. So there's an automatic delay and a slowdown in terms of how rents respond to market pressures anyway.
Yeah, and that's the hard part is right now you go, well, what do we do? Last year was a big year of growth. How do we approach investing in property? Well, the fundamentals haven't really changed, right? Like the cities are still formed the same. What people want. Maybe it's shifted a little bit. Like I think that's a big learning. COVID, was a bit of an eye-opener. It was like, who thought a pandemic could happen? It's like one of those black swan events. But that shifted the whole way the whole world worked, especially how we work on a day-to-day basis. That was probably going to always happen, that this sort of remote work, efficiencies was going to happen. But I didn't think it was going to happen until the next generation sort of got into these leadership roles. And, so it might only be over the next 20 years, but it all happened in 1 year. And that's then created, investment opportunities in the regional areas and things like that. But those markets are so small, right? Like, the premium parts of those markets, and they've got a big supply potential issue within these areas because they've got lots of land in these regional areas, the house and land packages and things like that. So I just think, if you're investing in property, even though properties prices have gone up, you still don't step away from quality, because they're more expensive. And I think this is the hard part now is if you are looking to buy an investment property, I feel like you've got to spend more in 2022 than you did the last couple of years. And the sort of the opposite way I feel like people are going is, well, I'll just spend a bit less. The market's hot. I'll just buy something cheap. I'll just get into the market. There's no point buying that property because it's gone up 30%. Well, if you want to buy a quality investment, even though it's gone up 30%, that's what you'd still want to bet on over the next 10, 20, 30 years than this cheap property that hasn't gone up as much. And it's got other issues. So I think that's real dangerous for investors right now is that they don't want to bite the bullet and pay what they need to get a quality asset because it's gone up so much. And It
sounds so boring. We keep banging on about the same thing, really, but these things don't change. That's why they're called fundamentals. The thing too that it's something that it sort of dawned on me. I don't know. I was running a where to buy for investors workshop with actually with Megan and with Ken, and and you hear this line from people, oh, I don't want to buy in a blue chip area, or I don't want to buy in a really established suburb, or I don't want to buy, Balmain's a classic, and I refer to Balmain a lot purely because that's where my office is, but I don't want to buy in Balmain because that's already had its run. And I still hear this, and I go, do you think that it's never, ever going to grow in value again? And it's like, if it's already had its run and you invest in there, then you've actually got a bigger amount of money invested in a good area, which is sort of, it's like the snowball. You got more surface area, and so technically, if it performs well, you should do better than buying in an area, a lesser area. But the whole concept of that it's had its run, it's a one-off. And it's so wrong in property because it does feed people into this hotspotting type of mentality where you've got to get into the next hotspot and that's your one shot at really making money. It's the long term. It's the long, boring term that makes by buying a quality asset and holding on to it in a good area, blah, blah, blah. And it's really bloody boring, but it's so beautiful after that period of time and you look back and go, wow, that once I made that difficult decision of buying it in the first place, like it was pretty easy, really.
It's always about sort of, you're setting yourself up for failure if you go to the wrong people and ask for the wrong things. I remember I went to a seminar. I think it's quite hilarious. I was laughing at myself because I fell for it. Right, they were using Richard Branson as the the main star who was doing a talk. I'm like, oh, I haven't seen Richard Branson do a talk. It's only $80 a ticket or whatever. And I rocked up at this thing And they put him on right at the end. I was like, should have just went late. Obviously, they're going to put him on late. But I'm here now. I might as well just listen to the talks. And it was one after the other spruiking something. Forex trading, property in the US. Yeah, I can't remember. There was lots of just spruiking ways to get rich quick. And it was in a big stadium in Melbourne. And I remember just thinking, I was up top, and every time that, this person would do their pitch, and it was hilarious watching them. And then if you don't get in now, and everyone would just run. And so you're setting yourself up for failure going to that event, you know? And you're setting yourself up for failure. If you go into a financial advisor and ask for a financial plan that's a property plan to help you purchase a property, or where should I buy a property? That's the worst question you should ask, right? And so you just got to be very careful the questions you ask and who you ask them from, because there's lots of people that will just take that and go, okay, yeah, that's what you want. Right. I can give you that solution. And in property market, it's pretty rife, around sort of just recommending whatever it is that, they know. And unfortunately, they, haven't spent the time to build those networks.
And it's compelling, isn't it? I mean, we all want an easy life and we want wealth. And I want to know the secret that everyone else seems to know, but I don't know, or whatever. It's a dangerous, dangerous thing. And yet there's industries, and not just in property, that make a lot of money from this false belief that there's an easy way to do things. People just don't want to do the work. They don't want to actually go through the process, learn the fundamentals, apply the fundamentals, be patient, and do the work. And,
I think that's bang on. To be honest, financial advice is actually really simple. And it's one of the things where there's only so many tools you've got in your toolkit. And then firstly, it's like, okay, so work on your income and do a job that you're passionate about and that you can actually stay in long term. There's no point trying to earn money today if you don't want to do it tomorrow, right? And then live, a life within your means, right? And spend your money on the things that you get value from, and don't waste it on things that don't give you value, right? So experience material possessions, I guess you could say, and just being, understanding that you there's no point working 40, 50, 60 hours a week if you're not taking anything at the end of it. If you're only, 200 grand a year and you're spending it all what are you working for? Just to go out and have a good life, but not actually putting yourself, so you got to save, right? What you save, you then got to invest it, right? And, when you're starting out, you want to build that deposit up, and you might look at shares and, ETFs and all those sort of things to get going. But once you get a certain amount of money, then you want to probably leverage it, and that's where property makes a lot of sense, because you're probably earning an all right income. So it's buying good property. When you're on top of that, maybe you want to add value to that property, because that, you usually get good bang for buck. If you ever want to sell it, you probably got to increase your chance of selling it for a good price. Plus you get the lifestyle benefit. You want to look at, looking at things like tax benefits, like putting money into super, make sure your insurances are all sort of signed just in case you, get ill or pass away, and make sure you got your wills. And then once you got a home you love and a home you can grow into, let's say, a good asset growing for you tax-free, then you may want to buy 1 or 2 quality investment properties over the next 5 or 10 years, and maybe you want to start up a small share portfolio. Like, that's kind of it. That's all you can really do. And so that's sort of how, those are the fundamentals you just apply for the rest of your life, and compounding and making sure that you don't try to pick stocks and all that sort of trades, pretty dangerous way to play.
Well, there's a lot of evidence on that, isn't there? But the people that actually actively trade do worse than the people who pick, invest the time choosing good stocks and set and forget. There's loads of evidence around that and studies that have been done on that. Look, and so I guess what's the answer? The answer is, if you're wanting a property plan, it's like, well, you need a holistic plan. We don't yet know enough financial planners are out there who are able to give you that. And that's a massive gap in the market, and I don't know how easy it can be to be filled, but if you've got some suggestions, put your hand up, let us know, share it with us. Because you want the holistic plan, you want to know where property sits in that plan, how it sits, how it's meant to perform for you. It's not the be-all and end-all, and definitely the amount of properties you end up owning is not the measure of your success. And then, work through chipping away at those things one at a time that you've just outlined there. So basically, if you download this, get a transcript of just what Chris just said, and then that's your property plan.
I mean, one of the other challenges is that It's say you build out these businesses, and there's some businesses that do this, right? Is they have a financial advisor, right, who has a salary, is getting paid, and they have targets of how many plans, right? So if they've got customers coming in that they don't generate, the business generates them, they put them on a plate, and that financial planner has to convert them, right? So it's not their business. So they're just here, they're hitting their targets, they're getting paid a salary, right? So they're going to sell plans, right? If you go in there asking for a plan, they're not going to say, oh, I don't think it's a good idea. They're not going to have a job next week, right? So they're going to sell the plan. In that plan, they're going to have to recommend property because they're going to have a buyer's agent sitting next to them in the business, and their job is to recommend a property no matter what the budget is, right? And then the buyer's agent's going to get that plan with that client. The mortgage broker is saying, hang on a sec, we need to sell them debt. They're earning whatever it is. They need loans, right? And so everyone in the business is just thinking about their own little KPIs and their own business because they're not thinking long-term. They're thinking about their salary and their bonus. The reality is they haven't got a long-term mindset. They're an employee. And that's one of the dangers when you go for these businesses is that everyone is just looking out for their own individual situation, and the financial planner is trying to sell plans and insurance, and the mortgage broker is saying to the financial planner, hey, there's debt there. Why aren't you selling debt? And then there's property opportunity there. Why aren't you selling property opportunity? And everyone just sort of, supports each other within the business. No one's sort of putting a hand up and saying, hang on, I don't think this is really good advice. I don't think you should really do this. The bigger the business gets, the less the owners of the business see what's happening on a day-to-day basis. The reality is, how can you be? And unfortunately, you can't attract the best talent in these businesses because the best talent don't want to be the employees. They want to run the show and they want to, have their own business. The own financial advisors will go off and start their own ship. The best mortgage brokers will go and start their own ship. The best buyers agents will start their own ship. So the problem with these big companies is the quality advice gets very diluted. It becomes very cookie cutter. It becomes a sausage factory. And the quality advice just keeps on deteriorating because everyone keeps looking out for their own interests. And we've seen some big collapses in financial planning companies that do this because the reality is it doesn't take long for ASIC to pick up on it. And ASIC will start to look at the quality advice. A couple of complaints to ASIC will show this. The ASIC do an audit. They do a bit of a mystery shop. And then bang, they start to see that it's all conflicted advice and it comes down. A big company that went under recently was Dixon Advice. It was advertised in the AFR every week.
Oh, yeah. Big on the SMSF space.
Yeah, property. They were doing their own US property fund that sort of blew up, etc. What you mentioned around active funds is very true. One of the biggest funds in Australia is having a really tough time at the moment. There's, there was the poster boy of, the Warren Buffett of Australia. Most financial advisors would have, that company in their portfolios. And it's what you call like a star fund, like a top performing fund. And then it's underperforming, and there's fun people are saying, oh, why should I keep my money in that? I'm going to pull my money out. And everything changes at those funds. So even the best active managers go through down times, and sometimes they don't recover and they lose all the profits they made in the past. And so that's another problem we were talking about.
So, right, the title of this episode is really What's Wrong with Property Plans, and I think we just covered it. I really do hate to not be able to provide a solution other than do your own work, learn, and that is going to be your safest way. I want to find a way to scale it. I'm not sure it's even possible, but that's my project for this year.
Yeah, the only final thing I would say on this is that one of the hardest parts is that once you get your home and you try to go to these investment property things, is just be really careful of the buyer's agents that will go and buy everywhere. I don't think it's possible. Go and buy. We don't work with one buyer's agents. We work with lots in Sydney. We work with lots in Brisbane, lots in Melbourne, lots in all over the country, places in the country, And every time we hear about someone who's good in a certain pocket that we don't have any on, we go and suss them out. It takes time, but we know we've got a right solution because we've got that local expert who's the business owner, who's got reputation risk, that's they're focused on, and they're not focused on trying to buy everywhere. So, if you are trying to do it, really find that local specialist buyer's agent.
Absolutely.
If you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or North Shore, my team and I can help you buy without regrets. Reach out via my website, gooddeeds.com.au.
If you're looking to buy your first home, thinking of upgrading into a new one, or purchasing an investment property anywhere in Australia, my team love to carefully guide you on this journey. And most importantly, get the finance right. Reach out via our website, wealthful.com.au.
Thanks for joining us. We'd love to see you again.
And remember, don't be a Dumbo.